high. I am the inspiration that led success soar high. I will achieve, I will fly high. I am the I in SBI.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
Hello and welcome to the Business Standard Banking Show, where we tell you the story behind the recent developments in the banking sector. It is September 28th and I am Ruchika Chitravanshi. Today's cover story talks about whether it is time to bring back the 1,000 rupee note. Soumya Kanti Ghosh, Group Chief Economic Advisor, State Bank of India, joins us in Banker's View this week. In Banking for You, we will tell you all about tightening liquidity. For the Expert Take segment, our consulting editor Tamal Bandhopadhyay will talk to us about the recent inclusion of Indian bonds on JPMorgan's Emerging Markets Bond Index. At the end of the show, we will tell you the results of the last week's poll and the question for this week. In May this year, RBI announced the withdrawal of 2,000 rupee currency notes, the highest denomination in circulation. The future of this note after September 31st is still unclear. But is there a case for bringing back the 1,000 rupee note? Manojit Saha digs deeper in our cover story today.
With the deadline to return the 2,000 rupee denomination banknotes closing on September 31st, the key question now is what is the next step? That is, if the government will take away the legal status of that denomination. Moreover, is there a need to reintroduce the 1,000 rupee note after the 2,000 rupee note withdrawal? At present, the highest currency note is 500 rupees. Data released by the RBI in early September shows that 93% of the 2,000 rupee notes in circulation as of May 19, 2023 have returned. On May 19th, RBI announced the withdrawal of the 2,000 rupee bank note. Among the returned notes, 87% were back in the form of deposits and 13% were exchanged. On November 8, 2016, Prime Minister Modi announced that the existing 500 and 1,000 rupee notes were being withdrawn and would cease to be legal tender. The 2,000 rupee note was introduced during this demonetization exercise. The government has the power to withdraw the legal tender status of any banknote on the recommendation of the RBI board.
Because now that, as we know, that 90% or some plus would have already come, then natural next step will be for Reserve Bank and government to think about withdrawing the legal tender characters of this 2,000 rupee denomination. It goes with the principle that in any case, it was not the original thought or very considered thought. It was a tactical move at that particular point in time. So both government and Reserve Bank should be talking, discussing how to remove the legal tender characters of this 2,000 denomination. So that for that process is already well established based on the recommendation by the government. Based on the recommendation of the Central Board of the Bank, the central government can declare withdrawal of a particular denomination. That process they have to go through.
Gandhi says that since most notes have been returned, the amount left would be very small, and RBI is not likely to extend the deadline. The only consideration that the central bank may have is those who are abroad and were not able to come to India between May and September. The 1,000 rupee denomination banknotes were introduced in the year 2000. Some experts contend that if the 1,000 rupee note was required in the year 2000, then there is an even more pressing need now, since money's value has decreased over the years due to inflation and other factors. At the same time, digital transactions have picked up very strongly in the last few years, which negates the logic of a high-value currency at this point.
Simple answer to that will be no. There is no need for introducing any higher denomination now. Earlier time before the digital currency or digital payments have started in the whole world, including in India, much more strongly now. I would have argued that periodically we would need a higher denomination notes for transaction purposes, especially when the economies grow and inflation will also be there. So combination of inflation and economic growth may dictate higher denominations to be introduced periodically. That argument no longer holds good because of the current availability of digital payments network, such a secure way it is being done and much faster and safer. I do not think there is any need for higher denominations note of 1,000 rupee or any other denomination to come into play. And at the high end, because high end will always, high value transaction will always require safety from the perspective of both the sender and the receiver. And normally any legal transaction, nobody should have any hesitation to use the digital payments. So that is why I do not think there is any need for higher denomination notes to be introduced. Just that now that we have withdrawn 2,000, whether 1,000 rupees note should be coming back or not, I'm not subscribing to that.
Interestingly, India's digital payments started picking up from the time of demonetization and gained further momentum during the pandemic. In August, the country's most popular instant payment mode, Unified Payment Interface or UPI, crossed 10 billion transactions for the first time. In terms of value, UPI transactions topped 15 trillion rupees in July and August. Will the RBI let the 500 rupee note remain India's highest denomination currency note, or will it reintroduce the 1000 rupee note? Only time will tell.
So experts feel there is a pressing need to reintroduce the 1000 rupee note. Our viewers also agreed. The results of our poll, with 59% agreeing that there is a need to bring back the 1000 rupee note, shows that. Moving on to our Banker's View segment. This week, Business Standard's Manojit Saha caught up with Soumya Kanti Ghosh, Group Chief Economic Advisor, State Bank of India, to discuss household financial savings and more. Here's the chat.
Hello and welcome to the Business Standard Banking Show. The net financial saving of household sector dropped to 5.1% of GDP in FY23, which is the lowest in 50 years. Latest data released by the Reserve Bank of India showed. Household savings are important for the investments in the economy. Soumya Kanti Ghosh, Group Chief Economic Advisor of State Bank of India, came out with a paper after RBI released the data, arguing that financial savings should not be seen in isolation, but in context to overall savings that include physical savings. We have Mr. Ghosh with us today to discuss some of these issues related to household savings. Mr. Ghosh, welcome to the show.
Thank you.
There is a dip in the net financial savings as a percentage of GDP, while financial liabilities jumped to 8.2 trillion rupees since the pandemic. Do you think the households are borrowing more for consumption needs?
Yeah, I think, Manoj, that's a very pertinent question. But just let me give you some context of the data, because which will make understand the followers a little bit. If you look the data from FY20 till FY23, the total financial liabilities, I think, increased by around 8.2 trillion, and the total assets of the households increased by 6.7 trillion. So that means there was a decline in net financial savings by around 1.5 trillion. And the question is that, and the increase in the net financial liabilities of the household, does it portend anything? There is both two parts to it. The first is yes and no. The first thing is that yes, there has been a decline, increase in the liabilities of the households. But on the other side, the total household savings is always physical savings plus financial savings. If you remember, during the early days of the FY12 and 13, the household physical savings was around 65 to 75% of the overall household savings, and financial savings were around 30%. These numbers actually had increased significantly with financialization of the economy, formalization of the economy, financialization of the savings. And at some point of time, this number had increased significantly in FY 1920. But what has happened in the last 3 years since pandemic is that there was a perceptible decline in interest rates. So what it has done is that it has allowed the households to rejig their portfolio in favor of the physical savings also. The share of the physical savings, which was at 48% in FY21 out of overall household savings, is supposed to increase to around 65 to 70% in FY23. So that means there has been a significant rejig in the household savings. So this is point number one. The second point is that even if there has been a decline there has been an increase in the household indebtedness, but the point is that whether household savings as overall has declined or not. If you look into the data, we'll actually find that the household savings has increased in FY22. It is also going to increase in FY23, even after such a decline in the financial liabilities. So what is clearly apparent is that a shift has been going on from financial savings to physical savings, because as all of you know, the real estate sector has been seeing some sort of a turnaround. There has been an increase in the property prices also, if you look at the RBI price index. So all of this and the low interest regime may have perhaps incentivized the household to move a part into the physical savings. And I think at the end of the day, this is not a bad thing, because if the household sector does well in terms of the overall savings mobilization on the overall front, I think at the end of the day, that is good for the economy in terms of financing of the deficits which we have.
While home loans and vehicle loans are rising, but so is credit card spending. Essentially, when we say that there is a decline in household savings, it means that there could be some stress. Don't you think that the sharp rise in credit card spending is some sign of stress that households are borrowing more for consumption needs?
See, I'll give you one important data. If you look into the overall gross bank credit, and if you look at, I'm not looking at the NBFC sector because NBFC loans are typically more of housing loans and auto loans. But if you look into the overall overall bank credit, and if you look at the retail portfolio, yes, credit card receivables are a part of it. Personal loans also are a part of it, but personal loans mostly go to the salaried segment. But I'm keeping that aside. Even if we take the argument that credit card receivables has gone up, but if you look into the housing loans, if you look into the auto loans, if you look into the loans basically which are going for the purchase of assets, I think that number is close to 60% in the overall credit expansion of the retail which has taken place in the last 3 years. So I think from that point of view, yes, there has been an increase in the household loans, but a large part of that is actually going and financing physical assets. And the second point is that the overall housing indebtedness in the Indian context is still significantly on the lower side. We have a household indebtedness, which is, I think, around 36.5% of GDP, which is perhaps the only country which is lower than that is Russia. But if I take out Russia because of reasons, all other countries, including China, has a household debt to GDP ratio, which is higher than that. And in Indian context, most of this debt is secured debt. So because it is backed by adequate mortgages or adequate collaterals. So from that, even the gold loans which the people take, that are also collateralized for in the term of the gold jewelry. So I think while of course, there has been increase in the spending of receivables, but I think that is not so large in the current context so as to create a matter of concern for the households.
The other point is inflation. Now, since the pandemic, inflation has stayed on the higher side. RBI has been fighting to keep inflation under control. What kind of impact the higher inflation may have on the financial savings?
Yes, so that's again is a very interesting point, Manojit. I think the increase in inflation can actually has an asymmetric impact. When the inflation increases, people could actually see that since their financial savings are getting eroded, so it is better to invest in those assets where we are seeing an appreciation. So, and the first thing comes to the mind for a household is why not invest in the real estate sector? Because that actually could give me some amount of increase in my value of the portfolio in this time. So while inflation may result in some sort of an erosion in the net value of the total liabilities, but it also increases the overall household physical assets, because the household could actually see that as an opportunity to invest in something which they may not have done earlier because of whatever reasons.
It will help revive investments in the economy, the result of the shift in to physical savings. That's a very valid point. Mr. Ghosh, as always, it was a pleasure talking to you. Thank you for speaking to Business Standard.
Thank you. Thank you so much.
The liquidity in India's banking system stood at its lowest level in nearly 6 months on September 19th. While lenders have been drained of funds due to factors like corporate advance tax outflows, the RBI has injected funds into the banking system to address the tight liquidity conditions. Against this backdrop, Bhaskar Kumar decodes what tightening liquidity means.
Borrowing costs have risen. Why? Because of tight liquidity conditions. In fact, on September 19th, liquidity in the Indian banking system had reportedly declined to its lowest level in close to 6 months. According to the report, this happened because corporate advance tax outflows and the Reserve Bank of India's actions to stabilize the rupee have eroded the funds in the hands of lenders. Between September 16th and 19th, at almost 70,000 crore rupees, the central bank had infused the highest amount into the banking system since March 24th. This was another indication of the tight liquidity conditions. Also, in August, the RBI, or the Reserve Bank of India, had mandated that banks maintain an additional 10% cash reserve ratio for an increase in deposits between 19th May and 28th of July. This led to the withdrawal of over 1 trillion rupees from the banking system. Even though the situation may have improved now, let's delve into what is tightening liquidity, also known as liquidity deficit, means. In the banking system, liquidity is a term that refers to readily available cash that lenders require to meet their short-term financial and business needs. When the credit demand coming from borrowers start outpacing the funds that are available with banks, we say that banking system liquidity is in deficit. Also, liquidity is considered to be in deficit when the banking system is a net borrower from the central bank under the liquidity adjustment facility. And what factors can be responsible for liquidity deficit? These can range from advance tax payments by corporates and a jump in bank credit to incremental deposit growth not keeping pace with credit demand. The other causes can be an increase in GST outflows and cash withdrawals during the festival season. RBI's intervention to stem the rupee's fall against the US dollar can also be a factor. Banking system liquidity. If the banking system is a net borrower from the RBI under the Liquidity Adjustment Facility, or LAF, we say that the banking system liquidity is in deficit. The reversal would make it a surplus. What is the impact of tightening liquidity? Tight liquidity conditions can lead to rise in yields of government securities, and this could also lead to rise in interest rates for consumers too. To manage this situation, the RBI can increase the repo rate, which would mean a higher cost of funds. Higher repo rate would mean higher lending rates by banks and therefore higher interest rates for consumers.
I am the blue of the limitless sky. I am the inspiration that lets success soar high. I will achieve, I will fly high. I am the I in SBI.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
Now that we are all caught up on liquidity tightening, let us move on to the next segment. I spoke with Tamal Bandhopadhyay, our consulting editor, on inclusion of Indian bonds in JPMorgan's Emerging Market Global Bond Index and some other happenings in the banking space. Here's our expert take. Hi Tamal, welcome to the banking show. In your column this week, you've talked about what made big headlines earlier, the Indian bonds in global markets. Now, government has welcomed this move, and it shows the confidence of the foreign markets in India. You also listed out a lot of positives that this means for us. Can you tell us a little bit about what is the good and what are some of the concerns behind this move?
Now, what are the positive things? Is this the funds flow, FPI flow, it's always good. This will free up the banks, because banks, you have seen that even now, both on year as well as so far this year, the credit growth is higher, both in absolute term as well as in percentage term than deposits. So banks can get money, free up their money, and they can support the credit growth. Of course, theoretically, again, it can, because the supply side is taken care of, the bond prices may rise and bond yield may go down. That will help the government cost coming down, government borrowing cost. And there's a linkage between the yield of government bond as well as the corporate bond. So that means the corporates also will get little cheaper money, theoretically. And of course, because of the flow, it will have a positive impact on the rupee. So everything is fine in that sense. Again, as I said, theoretically.
Negative. What are the concerns now that
you see, there is one JPMorgan note says that they will check the liquidity of bonds for all the countries which are part of the index. And this exercise will start in January. Now, I think this is a big time challenge for the Reserve Bank of India, because unfortunately, not too many bonds are liquid, because if you are buying, you need to also have an exit route. But it's not. At any given point of time, you will see in India, probably 6 or 8 bonds are liquid, not too many. So Reserve Bank of India has to create liquidity in the bond markets. That's one part of the thing. That's a challenge. Other part is this: if it is dominated by local investors, which it is now, you don't care about many other things. But if certain things happen, certain negative developments globally, if anything happens to India rating or any concern, internal or external, and if there is a sudden exit of these guys, the FPI, foreign investors, then you will see the yield going up, and a lot of volatility in the bond market, which nobody wants, and impact on rupee.
Something else that made news recently were remarks of former finance secretary about Urjit Patel and the kind of money hoarding that was happening. Can you tell us a little bit about this, some perspective on what was going on?
Well, you are talking about Subhash Garg's book, right? And which both in social media and normal media also been there around. Well, I don't think there's any surprise in it, because if you see what led to Dr. Patel's exit, even though his formal resignation cited reasons personal, but everybody and his aunt knows that there was a tussle between Government of India and RBI at that point of time, and the boardroom was actually a sort of war room, and there was a long, prolonged board meetings. I think that kind of meetings in RBI's history for the first time happened, not once, but twice or thrice. And the entire government brigade was led by Mr. Subhash Garg, who was part of the finance ministry at that time, finance secretary. And the bone of contention, among others, at that point of time was there are multiple issues were there, but the main thing, one of the things was there, how much money RBI should transfer in the form of dividend or surplus. Government wanted more money, and there are other issues also. If you remember, Arun Jaitley was the finance minister at that point of time, if I'm not mistaken, and there was a threat that they will cite under the RBI Act certain thing which government can give direction to Reserve Bank of India. So it went to that level, and they wanted more money. So that's the point is talking about Subhash Garg. And then what happened? Governor Dr. Patel resigned, and Mr. Das came as a governor. And first thing he did to sort out the issue is to set up a committee led by Dr. Bimal Jalan, former Reserve Bank of India. The committee came out with its report. It was within a few months, everything happened, and the government got more money. But did it get as much money as it wanted? No. So Mr. Das managed it wonderfully well, like he manages everything else, managed in the positive sense, I'm saying, that he did pass on the money which government wanted, but not as much quantum as government wanted. And nobody can blame him. There could not be anything more, because this thing was decided by a very reputed committee led by Dr. Bimal Jalan. So that's the story.
Recently, talking about RBI, the Deputy Governor Swaminathan has talked about the kind of customer service we have, and they have said that banks should not classify customers' complaints as queries, and that central bank will not hesitate to act against banks who indulge in such behavior. So, Tamal, what is the kind of customer service that the standards that we have in India right now?
Well, unfortunately, if you ask me, irrespective of the nature of the bank, it could be highly valued, it could be investors' darling, it could be big size. I'm not citing any name, but unfortunately, customer service is not on the radar of most of the banks. It is unfortunate. In some of the banks, it literally stinks. And Reserve Bank of India has been trying to address. They have revamped the entire ombudsman scheme in multiple ways. But unfortunately, it's if you see now most of the banking is done digitally, and then the physical whatever happens is this: they just sell. They're the marketing outfit. So the moment you have little more money in your fixed deposit, in your savings bank, and you walk into this, you'll be scared that you'll be grabbed by somebody and asked you to put in either mutual fund or insurance, so on and so forth. I mean, I know some cases where it happened is this: the parents died, and the nominee, the son and the daughter, they could not withdraw the money because it was year end. And banks would lose that kind of money because there's a target if it's a little hefty money. So if suppose the mishap happens in February, you have to wait till April to get the money, because they need to, keep their target on the 31st March for the quarter thing. So as I said, irrespective of the size of the bank, irrespective of the value of the bank in stock market, generally most banks lack in customer service. Very few actually care for the customers. That's the unfortunate case.
Good that RBI has raised this issue, and it has said that it will take action. So hopefully banks will also get their act together. Thank you so much, Tamal, for all your insights today, and we will see you next week. With this, we have come to the last leg of this week's episode. It is time now for poll results, as I mentioned earlier in the show as well. Here's what we asked you last week. Should the RBI reintroduce the 1,000 rupee currency note? 59.1% of our respondents agreed that the 1,000 rupee note needs to make a comeback, while 41% said no, there is no need to introduce this currency again. While the prices of tomatoes may have come down, RBI is keeping a close eye on the inflation numbers, which continues to be an area of concern. This is the backdrop for the upcoming monetary policy. So here's what we are asking you this week. Do you expect the RBI to increase interest rates? Our poll is open today, that is Thursday, and you can respond on Twitter, Instagram, LinkedIn, Telegram, and our website. We will be back next week with more news and analysis. Thank you for watching.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.
I am the blue of the limitless sky.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.